Welcome to Accounting 101. Today we'll look at income statement under the following subtopics: the preparation and presentation of annual financial statements, pre-adjustment trial balance, cash basis, accrual basis, nominal accounts section, profit or loss. By preparation and presentation of annual financial statements, we are looking at an income statement as a statement that forms part of your annual financial statements. By your annual financial statements, we are looking at a statement where we record annually, meaning that the transactions or entries being made in these income statements, they are off for 12 months, meaning that whatever we do, we are reporting to the users of financial statement, namely your shareholders, your investors, and your SARS for tax purposes. So, whenever you're looking at an annual financial statement, you are preparing from the beginning of a financial period until the end of the financial period. So, basically, it's a summary of what was happening with regards to your financial activities for that particular entity. When we look at a pre-adjustment trial balance, a pre-adjustment trial balance is important simply because whenever we prepare the income statement, we use a pre-adjustment trial balance. A pre-adjustment trial balance gives us the total and balances that we require to prepare the income statements. For example, sales as an income account. Sales as an income account, we can only get it once we look or once we are given what? A pre-adjustment trial balance. Then we start preparing our income statements. So in the pre-adjustment trial balance, we focus on your nominal account section, the below part of your income statement, which means we are looking at your incomes versus your expenses so that we are able to determine that for this particular financial year we made a profit or we made or suffered a loss. That is why we use the nominal account sections. And with nominal account sections, they do not have your balances, but they have totals that we transfer from a particular month to the next month. Again, your pre-adjustment trial balance includes your nominal account section, your income versus your expenditures. We prepare a pre-adjustment trial balance simply because we want to make sure or ascertain that indeed the concept of duality or a double entry system was maintained. With the recording of all those entries, your debit is equal to your credit. Now, with your pre-adjustment trial balance, we are also looking at your nominal account sections, meaning that your income account will be recorded on your credit side. Then your expense or expenditure accounts, they will be recorded in your debit side. So that is how you identify accounts that are incomes and separating from accounts that are expenses. Accounts that are income accounts, they are recorded on the credit side. Then accounts that are expenses or expenditure accounts, they are recorded where? On your debit side. Then let us look at cash basis. Whenever we prepare the income statement, we use two accounting bases of recording. We use namely cash basis and accrual basis. By cash basis, we are looking at a basis that allows us to record a transaction or to make an entry in our financial statements or in the income statement to be more precise. Then we make this entry if that transaction is of a cash transaction. For example, we sold goods for cash, then we record it as cash sales. That is a cash transaction. But if we decide to use only cash basis, it means that transactions that are not related to cash are not recorded. But for income statement purposes, we use two accounting bases of recording, or we use both accounting of recording, which is cash basis and accrual basis. With cash basis, again, we only record cash transactions. Another example, we paid for repairs. We are going to record in the income statement, but we're going to record the account for repairs since the beginning of the year until the end of the financial year, because we are reporting the annual financial activities of this particular company or entity to the shareholders or to the users of financial statement, to include all the users. So your cash basis basically it's limited only to your cash transactions or cash entries. But again, even if it's limited to cash transactions, it must include transactions from the beginning of the year until the end of the financial year, because we are reporting for a particular financial year, not for a month or a day. That's your cash basis. Paid for water and electricity. We need to record since the beginning of the year until the end of the year, simply because we are saying for this year, for water and electricity, this is the amount that have been paid. That is what we refer to as cash basis. Then we look at accrual basis. With the accrual basis, we record that a transaction has occurred, even if cash is not received or paid. So, with the accrual basis, even if cash is not involved, but we record that a transaction has occurred. So, the main focus here is not limited to a form of payment, whether you are receiving or paying, but a transaction has occurred. So we are recording that something happened between us as a company and the other party or the third party. It could be a debtor, it could be a creditor, it could be maybe any other form of an entity, maybe SARS, or maybe the issue of a financial institution. But we record that a transaction has occurred, even if cash is received or paid. So, with your accrual basis, for example, with regards to your sales account as an income account, we will record even if goods were sold on credit or service was rendered on credit, simply because a transaction has occurred. Goods that we bought or that were previously bought by our entity are now with our or are now sold to our debtor or our accounts receivable or your debtor. So what will happen here is that since goods are no longer with us, we will need to adjust towards an inventory account. If we adjust an inventory account, then a sale has occurred. But this sale is not a cash sales. There was no exchange of money, but goods were sold on credit. They gave us a promise that on this particular date we will pay. So such transaction, such movement that has occurred between us and our debtors, for with regards to your accrual basis, we must record because a transaction has occurred. Since when we refer to an accrual basis, it is not limited to cash. So cash is not an issue, but our focus here is more of a broader scope where we look at a transaction occurring between us as an entity with the debtors. Again, if we decide to buy goods on credit, we did not pay, but we owe them. But also, we did receive the trading stock or an inventory, to be more precise, or to use a more updated term. So, when we buy these goods on credit, we need to update the balance of inventory as an increase movement since we are now having more trading stock. But again, we need to acknowledge that we are now owing our creditor. So now we are creating a payable account. So with accrual basis, we will include that amount with your cost of sales once those goods have been sold. Even if they were once those goods have been sold, because whenever we are calculating cost of sales, we even add the purchases account. It means that with your purchases, we will include these goods that were bought on credit, even if we haven't paid, as we are preparing the financial statement at the end of the financial year. We can also look at the accrual basis in terms of maybe water and electricity. If in the last day of the financial year we haven't paid these particular municipalities, we are owing them an amount for water and electricity, we will include it in the income statement because this particular transaction, even if the payment has not been made, but this transaction belongs to this financial year, and we're going to include it because the transaction has occurred. We have been made aware, or we have been informed by the municipality that we are owing this amount of money. So we record this transaction so that whenever we present this financial statement to the users of financial statement, they are found reliable. And for the purpose of audits or purpose of auditing, they are also found, these financial statements are also found reliable simply because we have disclosed all information using the income statement, including incomes for a particular period, 12 months. Even if cash is received or cash is not received, we include it because we are disclosing the revenue that we have received, and we are disclosing the accrued or the accruals or revenue that we expect to receive, which will form part as your asset when you are preparing your statement of financial position or your balance sheet. So there is an accrual basis. Now let us look at an accounting cycle for a company or accounting cycle for companies. When we are referring to an accounting cycle, we are referring to how do we record transactions or the steps or stages that we go through or undergo whenever we are recording what? Your accounting transactions from the first step to the last step. This accounting cycle is called a cycle because it's an ongoing process from the beginning of the financial year until the end of the financial year. Then, once we start a new financial year, we start from the basics. We start from point A until the end of the financial year. So, we are referring to a process that goes on and on. Number one, we are referring to a source document. Source document, we are looking at an evidence or a document that validates that indeed a transaction did occur. So we are using this source document. It's called a source because it gives us the information, the primary information that we need to record a transaction. Again, from a source document, we are able to understand what happened. We are able to get an idea as to where or on which journal and how to make that particular entry with regards to a particular journal using a source document. Then an example of a source document would be a tax invoice or a receipt or a check counterfoil. We are referring to a source document. With a receipt, whenever we receive an amount of money, what we normally do, we issue a receipt that is given to a customer. Then a duplicate or a copy of that receipt is retained by us so that we are able to record. Then we normally use that duplicate source document or that duplicate of a receipt to do what? To record the transaction, to acknowledge that we have received an amount of money or we have received a payment. Then we can also mention a check counterfoil. A check counterfoil or no check duplicate or check given to supplier or individual as payment and is returned to the owner once processed by the financial institution. That is an original. So when we are paying using a check, we write or we sign a check or we complete a check, then give it to the person that we are paying or a supplier to say this is the source document to him or to his company or her company to say a transaction has occurred. We have made a payment to you. So it's also regarded as a source document. Then a duplicate, not check duplicates. The check counterfoil stays in the checkbook for entry into own records. So a check counterfoil is that part that we as a payer retain so that it could give us guidance. It becomes our duplicate, it becomes our copy so that we are able to record a particular transaction to say we have made a payment. It's also a source document. A bank statement can also serve as a source document. How? With regards to transactions such as your bank charges. Because for us or for us as a company to be able to identify these bank charges, we need to do what? We will need to pay or we'll need to print out a bank statement so that we are able to identify those charges or those payments that we made. So they are recorded or in your bank statement, and we use a bank statement for that to do what? To record it because it's a source document. It's a document that gives us information with regards to what happened. We made a payment for bank charges. So it's also regarded as what? As a source document. Then once we have these source documents also will give us direction or a clue or heads up with regards to on which journal we should record this particular transaction. So let us now look at your journals, because we have covered enough with regards to a source document or source documents. So now let us look at your journals. Now we are starting our recording process or our recording cycle. A source document we do not record, but we retain this document that supports an entry that will be made from your journals up until your annual financial statement. So we must keep these documents safe for retrieval should they be requested as a form of an audit with regards to certain entries that we made in the beginning of the year or during the year. So if we are referring to journals or books of prime entry, we are referring to the journals that we use to record or to introduce or to record an entry for the first time. We use information directly from the source document to record in your journals. Whenever a source document is a receipt, meaning that we have received an amount of money, that source document is telling us to go and record where? In your cash receipt journal. Because in your cash receipt journal, that is where we record inflows of cash. But if we also look at your check counterfoil, we will know that we need to record where? In your cash payment journal. Because the check counterfoil is telling us that we have paid a particular supplier an amount of money. Then we know that we are going to record where? On your cash payment journal. Then, whenever you are referring to journal entries or journals or books of prime entry, that is where we record our daily transactions. The journals are not limited only to cash receipts and cash payments, but we can mention the few, which will be your sales journal, which will be your wages journal, which will be your petty cash journals, your sales journals, your purchases journals, your general journals. All those journals we record on our daily basis. So, in other words, there must be a column for dates. On the 1st of January, we made a payment. On the 2nd of January, we made a payment. On the 3rd of January, we received an amount of money. Then all these journals, they serve a purpose. For example, if we are referring to your wages journal, so with the wages journal, we record the wages of your employees on the daily basis. Salaries journal, we also record the salaries of our employees. We are referring to an issue of petty cash journal. Petty cash journal, we record payments that we made using petty cash journal. So all those journals we are referring to a daily recording journals. Then at the end of the month, we close these journals by having totals. For example, a total for sales journal will go to your income statement or your monthly income statement as credit sales or maybe cash sales. Then on a monthly basis, what we normally do, we are going to post two different ledger accounts. You will have your general ledger, you will have your debtors ledger, you will have your creditors ledger. So now, from your journal daily recording to your ledger accounts, which is now a monthly recording. So we are now recording monthly. Whenever we record using journals, we are recording, trying to categorize, trying to group transactions of similar nature. Unlike with the issue of journals, where we were recording an entry to its appropriate journal. But now we are recording, or we are grouping these accounts or these entries to their similar accounts. So on the ledger accounts, we have two types of ledger. We have balance sheet, we have nominal account section. With balance sheets, we are referring to ledger accounts for assets, equity, liability. And whenever on their folio number, you'll always have your balances. Balance brought down, balance carried down, and balance brought down. With your balance brought down, we are referring to an opening balance for that particular month. Then your balance carried down once you want to close off your ledger account for that particular period of time or for that particular month. Then the closing balance of the current month will be the opening balance of the following month. Again, it's worth emphasizing the fact that with your ledger accounts also, you have your nominal account section, normally denoted by N1, N2, N3, N4, N5. Your N1 is normally your sales account. Your sales accounts, you are referring to a nominal account sections. Here, you do not have your balances, but your totals are being brought forward from the last month totals to the current month total. So it's more of your closing total and your opening total. So whenever you are referring to balances with your ledger account, with your general ledger account, you are referring to assets, equity, and liability. But whenever you are referring to totals, you are referring to your nominal account section, which is your income versus expenses. And your income, they will always increase on your credit side and decrease on your debit side. With regard to your expenses, they will increase on your debit side and decrease on your credit side. So from journals to ledger accounts, it is a continuation of our recording process or accounting cycle. For example, your cash receipt journal total will go to your bank account on your debit side, and then your cash payment journal entries will go to your credit side, representing an outflow, representing a decrease of your assets. Remember, your assets, they increase on the debit side and they decrease on the credit side. Therefore, it is wise, or it makes sense for your total receipt to be recorded on your debit side and your total payments to be recorded where? On your credit side. But again, since we are referring to the balance sheet account, it means that a closing balance, firstly, for the previous month should be the opening balance. Then you take into account your total receipt on your debit side and total payment on your credit side. Then if you total or close off that account, you work out, you get your balance carried down. From your balance carried down, you will also get what? Your opening balance for the next month, because it is a closing balance at the end of the month and an opening balance with regards to the month to follow. So for your ledger accounts, we also need to look at your debtors ledger account. With your debtors ledger accounts, remember you started recording in your debtors journal. Your debtors journal, we are recording debtors who are buying goods from us on credit, or our customers that we are selling goods to them on credit. Therefore, cash is not involved. That is why we have a journal that caters for that kind of a transaction, for that kind of an entry where we record the credit sales. Then once you have recorded credit sales, it means on a daily basis, because it's a journal. So what we also need to do is to go and record on the debtors ledger. The debtors ledger now are per data, but a debtors journal is for, or rather, it's a collection of our credit sales within a month. So from our credit sales within a month, on our monthly basis, we now start to record, or at the end of the month, we are now starting to record these entries where on the ledger account of that data. If data A did buy goods during the month, then we'll also go and record or update his ledger or his balance, where we say plus, because he continued to buy on credit. If there is a payment, we are going to say minus, because the balance is being reduced due to a payment being made on that month. And we also need to record where on our creditors ledger. On our creditors ledger, we are looking at ledger accounts for the companies or suppliers that we bought goods on credit from. So we are looking at the number of companies or number of suppliers that we are owing, and the amount that we are owing in total, also the amount that we are owing as per the creditor, as per the supplier. So whenever we continue to buy goods on credit, that means we need to update the balance for that particular credit to increase it, because we continue to take advantage, or we continue to take advantage of an option that we were given by this creditor to be able to buy on credit. Then once we have done that, we also, or rather, should there be any payment being made during the month, we also going to need to record in your creditors ledger for that creditor to say we have made a payment, therefore we are reducing this particular balance, so that at any given point of time we are able to plan what our aging analysis, we are able to plan how to do these payments and how to collect with regard to your debtors for that particular period, so that we do not run out of cash. We are able to collect, we are able to sell goods on credit, we are able to recover or to collect that amount of money, but again, we are able to buy goods on credit. But at the end of the day, you should be able to pay those liabilities as and when they fall due, because we are referring to your current liabilities. Again, while we are still discussing your ledger accounts, specifically your general ledger, we also take into account the double entry system method or concept of duality, where there is a debit and a credit. So the accounting equation assists us here to understand the nature of the transaction with regards to the elements of financial statements. Whether are we referring to an asset, equity, liability, income, or an expense, that will give guidance as to where will be the opening balance. Debit side, if your assets are increased on the debit side, it should be on your debit side, or on your credit side. It depends with regards to the reaction or an effect with regard to that particular entry towards an account as a whole. Then let us carry on or move forward to your trial balance. Your trial balance again can be prepared on the monthly basis. and that trial balance we refer to as a pre-adjustment trial balance. And then trial balance can be prepared after or immediately after your income statement and balance sheets, which with that particular trial balance will be referred to as a post adjustment trial balance. So let us look at a pre-adjustment trial balance. So meaning that whenever you are referring to a trial balance, it must be very precise as to as to whether you are referring to a pre-adjustment trial balance or a post-adjustment trial balance. With your pre-adjustment trial balance, that is normally prepared on the monthly basis immediately after your ledger accounts. Now, why do we prepare your pre-adjustment trial balance? Your pre-adjustment trial balance basically serves as a tool to correct or to do some rectification on your ledger accounts, because those balances are immediately used to do what, to prepare a pre-adjustment trial balance, so that we are able to understand that when these ledger accounts were prepared, we did indeed take in place the issue of double entry system or duality concept or concept of duality, so that we are able to prepare this financial statement, or rather the ledgers are correct in such a way that the debit is equal to your credit. That is what we refer to as a pre-adjustment trial balance. It serves as a proof or evidence that indeed your ledger accounts were correct, or when you were preparing your ledger accounts, you applied the double entry system in a precise manner. That is what we refer to as your trial balance, as your pre-adjustment trial balance. Again, with your pre-adjustment trial balance, you have two accounts sections. You have your balance sheet account sections, you have your nominal account section. With your balance sheet account section, you are referring to your assets, owners equity and liability. Your asset increasing on the debit side, your liabilities increasing on your credit side, then your equity also increasing on your credit side. Then whenever you are looking at these balance sheet accounts, on the folio column will be referring to what, your B1, B2, B3, B4. And with regards to your non-current assets, you will be recording these non-current assets using what you are recorded at their historical cost, and recording also their accumulated depreciation. With the accumulated depreciation, you are referring to an account that is not an asset liability, nor what, nor the equity, but it serves as what, as an account that gives negative effect or that reduces the asset. So whenever an asset is increasing on the debit side, your accumulated depreciation will always be on the credit side to reduce the historical cost, to bring it low or to bring it down to what, to your carrying value, carrying amount, or a book value. Then your total with regards to your balance sheet should also do what, be equal, your debit should also be equal to your credit. Then you go below to your nominal account sections, your N1 to N11, if that's the case. Your sales account, income versus expenditure. Your sales accounts are recorded where, on your credit side, or your income account to be more precise, they are recorded where, on your credit side. Then your expenses or expenditures for that particular entity, they are recorded where, on your debit side. And your debits, including the balance sheet section and nominal account section, should equals to your credits from your balance sheet at the top account section, including or adding what, your nominal account section. Then, when you are preparing your annual financial statement, your income statement, you will be using what? A pre-adjustment trial balance. Adjusting those balances, adjusting those totals before preparing what? Or presenting this financial information or this annual financial statement to the users of your financial statements. Then you will have what we refer to as post-adjustment trial balance. Your post-adjustment trial balance also serves as a proof that the adjustment we made correctly to the pre-adjustment trial balances, and therefore the concept of double entry system or the concept of duality concept was maintained even after making those adjustments from balances and total that were not adjusted. So for both purposes, pre and post is to maintain or make sure or verify or validate that your concept of duality or your double entry system was taken into account or is in line with what is being prepared with your post adjustment trial balance. Now, let us look at your annual financial statement. Your annual financial statement, as the term suggests, annually, meaning that we record once a year. We can prepare this financial statement on a monthly basis, but once we call them annual financial statements, we are reporting for the whole financial year, from the beginning of the financial year until the end of the financial year. So, for example, your sales account will be from the sales that we made from the beginning of the year until the end of the year. Amount for rent income received, it will be from the first month until the last month of the financial year. So basically, it's a summary of financial activities with regards to income versus expenses, or revenue versus expenses. So, with your income statement, we are referring to a statement that uses two accounting bases of recording, your accrual basis and your cash basis. So, your profits then doesn't necessarily mean the amount in your bank account, but basically it refers to an amount in your bank account plus your accrual plus your receivables, an amount of money that is not yet received, but we have earned it but not yet received, but it belongs to this financial year. Then we record in your income statement. Then at the end, we will need to determine whether we have made a profit or a loss. A profit is distributable to the shareholders. The loss is also shared to the shareholders. It means that we are trying to determine whether is our company profitable or not, not necessarily determining how much money we have in our bank account, because if we want to do that, we will also need to do your cash journals, cash payment journals, cash receipt journals, and your bank reconciliation statement. That would give us a detailed balance or an accurate balance that we have on our bank account. But for the purpose of income statement, we are looking at an amount of money received from sale of goods or service rendered, but also with regards to receivables, your credit sales. Then also with your expenditures that we expect to pay, they are within that financial year, and maybe by any reason it could be those expenditures were not paid for. What will happen? We also record for 12 months because we are reporting for a financial period. Even if these payments were not made, but an assumption or a disclosure or information should be given, or it must be emphasized that this particular entry or payment was not made, yet it belongs to this financial year. So that we prepare and present financial statements that are reliable, that won't mislead users, that whenever users decide or try to project or foresee or estimate the future of this particular company, whether to regard it as a going concern or not, they will use this financial statement because they truly represent the state of the financial affairs for this particular business. So your income statement, we are looking at the below part of your trial balance, which will be your nominal account section, your income versus your expenses. Then let us look at your statement of financial position or your balance sheet. Your statement of financial position, we are looking at the upper part of your trial balance, whether pre or post. Then what we need to do here for the purpose of making sure that we prepare an accurate statement of financial position, we will need to use or we will need to first make adjustments with regard to the pre-adjusted trial balances. Then once we are done with that, what we will need to do, we need to present your assets, owners, assets, plus owners, assets plus owner. We need to confirm that the accounting equation is correct, where we say assets plus owner's equity is equal to liabilities. Or where we need to say your asset is equal to owner's equity plus liabilities. So what we need to do with your statement of financial position, there are also notes to financial statement that we need to prepare, like your PPE note, or also known as your tangible asset note or your fixed asset note. All those notes must be prepared where before we prepare your statement of financial position, your equity, your non-current asset versus your current asset. By your non-current assets, you are referring to vehicles, equipment, land and building, or properties. Then once we look at what your equity, we are looking at your share capital, we are looking at your retained earnings or retained income. Then once or your general reserves, they also form part of your equity or any other form of reserves. Then for your liabilities, we'll be referring to a current liability and non-current liabilities. Your non-current liabilities will be referring to your long-term loans, but your current liabilities will be referring to your income received in advance, or your accrued expense or expense payables, your creditors controlled or accounts payables. All those accounts form part with regards to your current liabilities. Then again, on the statement of financial position, because you are referring to balances, your totals must be in balance, so that again the concept of double entry system or concept of duality is maintained. Analysis and interpretation of financial statements. We are looking at the last phase of our accounting cycle, where we are analyzing the financial statement that we have prepared. We are analyzing transactions from the beginning of the financial year until the end of the financial year. So when we are analyzing financial statement, we are done with the preparation and presentation of financial statement. But what we are doing now, we are looking at this financial statement with an analytical view where we say our main focus now, we are interpreting them in a different manner. We are interpreting them using the financial indicators or what is called ratios. So that is another way of interpreting this financial statement in such a way that the users of financial statements who do not understand accounting or who are clueless when it comes to accounting get an opportunity to interpret or to read or to make sense out of the financial statement that we have prepared for them using what percentages. So now they are looking at issues or rather elements such as increase or decline, growth or decline. Now, how do we do that? For us to be able to analyze and interpret financial statement, we will need what we refer to as comparative figures. By comparative figures, we are looking at presenting financial information using two different accounting periods. In other words, we are comparing the current year to the previous year. So, what we are doing here, we are trying to give users a financial statement or mainly shareholders where we say if you look at the current year versus the previous year, you can see that last year we made sales or revenue of 10 million rands, but this year, the current year, we made 15 million rands. That means users of financial statement can see that the company is growing, the company is generating more sales than what was generated on the previous financial year. So once we start presenting information, financial information in that manner, it creates more system where the users are able to interact, the users are able to use this financial information to make decisions or to interpret this financial information in a manner that will make sense to them. Again, what is important to the users of financial statement is the issue of income versus expenditure and the issue of assets versus liabilities. In other words, the users of financial statement would like to see an improvement with regard to your revenue generated that will result in an improvement regarding your profits. So, in the previous year, if you have 50,000 rands of profit, then for us or for the users of financial statements to indeed be sure that this company is a growing company, they will like to see more revenue being generated and more profits for this particular company or for this particular financial year. Then also they would like to see the issue or the ratio between your assets and your liabilities. That is why, for the purpose of these examples or for the purpose of this lesson, I will just mention the two ratio or just mention the few ratios or financial indicators so that we understand the importance of the analysis and interpretation of financial statement. The first one is the issue of solvency and liquidity. When the company is determined or is regarded as a solvent company, it means that their total assets or their non-current assets are higher or equals to their non-current liabilities. That is what we refer to as a solvent. Then how do we calculate your solvency ratio? Your solvency ratio is calculated using the following formula that I will mention, which is your total assets divided by your total liabilities. By total assets, I'm referring to non-current assets plus current assets. Then you get your total assets divided by your total liabilities, which comprises of your non-current liabilities plus current liabilities. The main aim for this financial indicator or for this particular ratio is that as an entity, we would like to see or get some information or evidence that will tell us how much do we have in total assets versus how much do we owe the external companies. By external companies, I'm referring to financial institutions that borrowed us amounts of money and our creditors control and all other liabilities that the company has incurred during the accounting period or during the financial period. For that one, we regard it as a solvency ratio. The intention for the solvency ratio is that we must have total assets that are higher or equals to total liabilities. Both they must be on their fair values. If a company is regarded as a company that is having more liabilities or higher liabilities compared to their total assets, that company is not regarded as solvent simply because we owe more than what we can pay should we be at a position where we sell all our assets. Then let us look at your liquidity ratio. Your liquidity ratio, we are referring to your current assets divided by your current liability. By current assets, I'm referring to short-term assets such as inventory account or also known as trading stock, your debtors control, also known as your accounts receivables. Yes, all those accounts. Then, with regards to current liabilities, we are looking at short term loans, we are looking at accounts payable. So, all those accounts are looked or rather are compared in such a way that the intention behind or the reasoning behind is that with our assets, with what we own currently, by currently we are looking at items that are easily changeable or easily converted into cash. Are we in a position where we say these should we convert these current assets into cash in a short period of time and be able to pay what our debtor, our creditors or our accounts payables and short-term loans as and when they fall due within a short period of time? That is the reasoning behind. Simply because for us to be regarded as a liquid company or company that passes the liquidity test, we should be at a position where should we sell or should we convert our current assets into cash, be able to pay our current liabilities, meaning that also our current assets should be higher or equals to our current liabilities for our company to pass the liquidity test. And it's worth mentioning that These ratios or these indicators are compared using comparative figures with regards to what we got on the previous year compared to what we recently calculated on the current year. Meaning that if previously we had a ratio of 13.45 is to 1, and on the current year we are having 15.4 is to 1. That means our company is growing and our company's assets are still maintaining a higher standard or a higher place or a higher bar compared to our current liabilities, of which it's a good indicator for the shareholders and potential investors, because this particular company is attracting what a lot of investors, because it clearly give the impression that this particular company is a financial stable company, is a growing company. This particular company is able to maintain its assets at a higher level or higher amounts, yet being able to minimize their short-term liabilities at their lowest level. So that is the importance of ratios or financial indicators whenever we are analyzing and interpreting these financial statements. And the financial indicators are not limited to the two that I just explained, but I explained these two for example purposes so that I can elaborate further with regards to my lesson that I'm currently presenting. And I so hope that my lesson will be a fruitful lesson to those who continues to listen, to view, to like, and to subscribe on my account. And lastly, I would like to take an opportunity to say thank you for your support so far. May God bless you. From Accounting 101, thank you, and thank you so much.